Good morning, students. Today our topic is super profit method. Next method, how to solve it. When business earns a certain percentage of profit, a certain percentage of capital employed, it is called normal return. But when the buyer advantage lies in the excess of normal return, it known as super profit. Example: capital employed, let it be capital employed is 10 lakh and return on capital employed is 15 lakh. Then it is 1,50,000. Normal return on capital employed in similar profit, in similar business is 10%. Then it is 1 lakh. So see, this 50,000 is the difference is 50,000, which is called super profit. How to calculate it? Here there is need of capital employed. So there are two approaches: liability side approach and asset side approach. Capital employed, what is the formula when we are taking the liability side? So that means we'll take the capital plus reserves and minus fictitious asset, if any, goodwill minus if existing in the books only, not in the adjustment. If it is given in the books, then fictitious assets minus non-trade investments. All these items will be deducted from capital and reserves. From asset side approach, all assets except goodwill, non-trade investments and fictitious assets. So that means those items which are deducting from capital and reserves, in asset side approach we will not deduct it, we will include it in the assets, and minus outside liabilities we will get our capital employed. Because super profit method, for the calculation of super profit method we need capital employed. If it is given then good, but if it is not given then we can use liability side approach and asset side approach. How it is possible? Now see, this is a question. Assets are given, liabilities are given. If we are taking liability side approach, capital as it is given, capital plus reserves, capital plus general reserve, 1 lakh, 1 lakh and 90,000. It is 2,90,000. Then minus goodwill as it is given in the books, minus 30,000. Fictitious assets, advertisement suspense, 10,000 minus, we will get our capital employed 2,50,000 from liability side approach. Then asset side approach, total of the assets. So what is the total of assets? Is 3,90,000. From 3,90,000, except what we are deducting it is except written here. I told you to include earlier. No, in above approach we are deducting, and here from the total we will also not include these items. In the liability side approach we will minus it from the capital and reserve, and from the asset side approach we will not take these assets if it is given all assets. So here we will deduct 10,000 goodwill, sundry creditors, outside expenses and fictitious assets, and minus total of all this 140, and we will get 2,50,000. So this is asset side approach and this is liability side approach. Here we just calculated our capital employed, only capital employed. Here no calculation of super profit is done. Only capital employed is calculated here. Now see the next. Average capital employed. Opening capital employed plus closing capital employed divided by 2 is the first step in the super profit method. और capital employed कैसे निकालनी है? As I told you earlier, liability side approach and asset side approach. Then calculate adjusted business profit. Actual average business profit, profits earned by the firm for the year is adjusted for abnormal gains and losses, if any. This is the first step. This is the first step of your average profit method. So adjust the profit, abnormal gain and losses in the business profit if it is given. The profit so determined is total and is averaged. So here you will calculate average profit according to the first method. Then normal profit is equal to average capital employed. Average capital employed will deduct from this to this, and we will get our average capital employed. Normal rate of return, this will be given in the question. Actual average profit minus normal profit. Average profit, actual average profit, step 2. Normal profit, step 3. Difference is your super profit and multiply by number of year purchase. This will also given in the statement. Now see the example how it is to be solved. Profit beta given is 3 years profit is given. Capital investment 60,000 is given. No need to calculate because it is already given. Normal rate of capital is 10%. Calculate the value of goodwill in 3 years purchase is given. Average profit beta 18, 20 and 22,000. Normal profit 60,000 multiply by 10%. 60,000 10%. 20,000 minus 6. This is your super profit, and number of year purchase you will get your goodwill. Thank you. Hope you understand.